Now let's get straight into things. Looking at Bamburi Cement out with results this morning, posting a 12.86% fall in pre-tax profit, but the company did manage to give investors a dividend. Your thoughts on the results?
From the results actually coming out, I must say that Bamburi has done pretty well, given the fact that there's been a high volatility in the fuel prices across the world, which has meant that the terms of production has gone up at least 17%. Transport fuel has also gone up. So, but they've been able to come up with serious cost-cutting measures, which have seen the firm run a mean strategy in terms of being able to increase output in such a volatile market. But also given the fact that despite the profit going down by at least 9%, we've seen that the overall growth performance has actually increased by 17%. And this is as a result of the cost measures that have been put in place. And as a result, that's why you've seen that in terms of fundamentals, the firm has a very good, stats in terms of being able to give value back to the shareholders with 2 shillings per dividend, which means that it's going to be one of the key stocks to watch at the market, because despite the volatility in terms of our competition from the region, from other local farms like other cement production farms, Bamburi is actually doing pretty well, especially given the fact that they have a lot of issues in terms of loan financing to be able to expand operations.
Looking at the type of infrastructure growth that is happening out there in Kenya, and looking at Bamburi and the type of performance we could see them pulling through in the second half, are you pretty positive? Like I said, pre-tax of profit down about 13%.
I believe that the next coming quarter is actually going to be pretty impressive for them, because one of the key strategies is to actually maintain the cost-cutting measures and to ensure that they keep diversifying and keep giving value to their customers and potential clients. And that's the only way they're going to actually be able to navigate through the volatile environment, especially in terms of competition. But also you see that they have an edge against other competitors in terms of how they're able to manage their loan portfolio. They're able to manage how to reduce the issue of fuel and cost production costs. So these are the 3 key issues that the firm will need to actually focus on as they go way forward.
Another company out with results, but that was in yesterday's trading session, was British American Investments, returning to profitability. We know that that's a pretty newcomer on the local bourse, listing last year.
We're seeing British America is actually performing in an environment that is virtually virgin ground in terms of potential and penetration. So it was just a matter of time before the firm actually returned to profitability, and we can be able to see that they have a lot of diverse investments across the board. And one of the key focus is actually going to be private equity investment options, which will enable them to be able to rope in a lot of revenue growth at the end of the day. But we've also seen that the key factor or the key market share for them is insurance, which we're looking at the penetration statistics in the country stands at between 3 to 7%, meaning that the firm has a lot of potential for growth. Also in terms of competition, given the fact that they have a lot of they have accessibility to a lot of credit for them to be able to expand their services, is one of the key driving factors that will see the firm actually keep returning to serious profit growth in the next coming quarter.
Looking at the insurance sector, like you say, we're only seeing about 3% penetration over in Kenya. People in Kenya seem not too positive about the sector. Looking at some of the companies that are on the bourse, is this the sector to be going into right now?
This is something that has been of concern to the stakeholders in the industry, and we've seen that the Insurance Regulatory Board has actually come up with measures to ensure that the negativity that's been shown by the public at large in terms of how to partake the services and products in the industry is actually reduced, something what you call investor confidence in the insurance sector. And we're seeing rules coming up whereby a lot of insurance experts who break any of the rules are going to be actually blacklisted across East Africa. This is one of the measures that the stakeholders are trying to put across to be able to create confidence. Also, the other thing is that in terms of civic education and perception of exactly how the industry really works, to be able to give value and benefit to the people is another thing that the regulators are actually trying to work on, to be able to create confidence, because it has a lot of potential. When you look at the companies that are actually participating in this industry vis-a-vis the market growth, it's a ratio of 1 to 7, showing that there's a lot of potential for growth. A firm like CIC or British America have a lot of potential to actually double the returns and profit margins if they actually focused on how to be able to entice the customers.
Let's look at Safaricom. The stock ended in positive territory yesterday, but there's news out that the staff are shunning the employee ownership plan. Not surprising given the fact that the share price hasn't really moved that much.
There's a joke going around in the blog sphere that Safaricom and Facebook shares resemble a lot, and this is the fact that when you're looking at the Kenyan stock market, Safaricom is the most liquid firm listed. On any given day, Safaricom is the biggest mover, doing more than 3 million shares on any given day. And this is a worrying trend, because unless the shares are consolidated, because most of the retail shares are held by local investors and in small numbers, which in terms of being able to create traction for positivity or any positive gain is actually leads to negative growth of the firm, because I mean, a share that's actually trading at 3 shillings and there's no possibility or any view of the shares being amalgamated together to be able to increase the value is actually going to be a problem. And unless the shares are consolidated into few hands, not necessarily few hands, but I mean, at least a reduced number of liquidity at the market, I'm seeing Safaricom employees going to keep shunning away the program, because this is one of the programs that actually creates value in a corporate like Safaricom. But unless they do something about the shares in the market, where they sit down with the regulator and agree on how either to buy back some of the shares or mop up the excess liquid, it's going to be a problem. And it has strong fundamentals. We're seeing it has a lot of good value in the market, but unless this is addressed, Safaricom will continue performing badly at the market.
Well, Safaricom is still to face a lot of headwinds, given the fact that we've got another player due to come onto the market in about 5 months' time.
At the moment, yes, they have a lot of traction, especially in data provision services. But we've seen local competitors in the telco industry coming up, and eating into their share. So it's a matter of time. In another quarter or so, Safaricom will actually now be forced to actually come up with new strategies to keep locking in its clientele, because we're seeing a firm like KCB has come up with an API platform whereby money transfer, mobile money transfer, is going to be a value option. And since if firms are going to go the KCB way, then Safaricom's M-Pesa product is actually going to be, it's no longer going to be of value to them. And this is the only thing that's actually been of benefit to Safaricom. So in another 6 months, Safaricom should actually be given warning, because once another player comes into the marketplace, a lot of rules and a lot of game-changing aspects are going to happen.